Think about everything school taught you. You learned the quadratic formula. You memorized the periodic table. You probably dissected something. You wrote essays about books you may or may not have actually read. And for 12 years, sometimes 16, you sat in classrooms being prepared for life. But here's what they never taught you. They never taught you how money actually works. They never explained what a tax bracket is or how to minimize what you owe. They never showed you how to read a financial statement. They never mentioned compound interest beyond a math problem you had to solve on a test and then immediately forgot. They never explained the difference between an asset and a liability. They never told you that there are two tax systems in most countries, one for people who earn wages and a completely different, far more favorable one for people who own assets. They taught you how to be a good employee. They did not teach you how to build wealth. And here's the uncomfortable part. That's not entirely an accident. The economy needs workers. It needs consumers. A population that understands how to build generational wealth through assets, tax strategy, and ownership is a population that's harder to keep on the payroll and harder to keep spending. I'm not saying there's a conspiracy. I'm saying the financial education system was not designed with your wealth in mind. And the evidence is everywhere. The top 1% of Americans own roughly 30% of all wealth. The top 10% own about 67%. The bottom 50% combined own about 3%. These gaps don't happen because rich people are smarter or work harder. They happen because rich people follow a different set of rules. Rules that aren't secret, but that most people simply were never taught. Today, I'm going to give you those 5 rules, the ones that actually separate people who build wealth from people who spend their lives wondering why they can't get ahead. Let's go. Rule number 1. They pay themselves first before everything else. What school taught? Save what's left at the end of the month. What the rich know? Invest first. Live on what remains. Let me describe how most people manage money. Paycheck hits the account. Rent gets paid, groceries, utilities, car payment, maybe some dining out, a few online purchases, some subscriptions, and then, if there's anything left over at the end of the month, maybe something goes into savings. If there's anything left, which for most people there often isn't. This is called paying yourself last, and it is why the majority of people never build meaningful savings regardless of how much they earn. Because here's what actually happens when you save what's left. Lifestyle expands to consume available income, every time, without fail. It's not a character flaw, it's human nature. We spend what we have access to. Wealthy people do the opposite. They decide on an investment or savings amount first, before lifestyle expenses, and that money moves automatically on payday. What remains after that is what they live on. Pay yourself first, then live on the rest. This sounds simple, and it is, but the psychological reversal it requires is significant. Instead of hoping there's money left to save, you guarantee there's money saved and then figure out how to live within what remains. You're not waiting to see if savings happen. You're making savings non-negotiable and making lifestyle spending the variable. The automation that makes it automatic. The reason wealthy people can consistently pay themselves first isn't willpower, it's automation. When your investment contributions happen automatically on the same day every month, the day after payday if possible, you never have the chance to spend that money on something else. It's gone before lifestyle creep can touch it. This is how wealthy people treat investment contributions, not as an option they exercise when they feel like it, but as a fixed expense, as mandatory as rent, non-negotiable, automatic, invisible. The practical setup is straightforward. Open a Roth IRA or brokerage account, set up an automatic monthly transfer for the day after payday, pick an index fund and set automatic investment. Done. Now, every month, without any willpower, without any decision-making, without any temptation to spend the money on something else, you are automatically building wealth. Wealthy people don't have more discipline than everyone else. They've designed systems that make the right behavior the default.
Start with whatever you can. Even $100 a month automated is better than $500 a month intended, because intended savings almost always become spending. Automated savings actually happen. The 20% rule that changed everything. Most wealthy people I've studied follow a rough guideline. Invest at least 20% of gross income before lifestyle spending. That's not 20% of what's left, 20% of the total, before taxes, ideally through 401k contributions, before lifestyle, before anything optional. If you make $5,000 a month, that's $1,000 invested before you think about anything else. Aggressive? Yes. Is it possible for everyone immediately? No. But it's the target that wealthy people set, and it's why they get wealthy. If 20% is impossible right now, start with 5%, then increase by 1% every few months. Most people never notice the difference in their lifestyle, but compounded over decades, the difference in their wealth is enormous. The rule is simple. Decide what you invest, then live on the rest. Never the other way around.
Rule number 2. They understand the difference between assets and liabilities. What school taught: work hard, earn money, buy the things you want. What the rich know: buy assets that produce income. Be careful what you call an investment. This is probably the most fundamental concept in wealth building, and it's something most people go their entire lives without clearly understanding. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. That's it. That's the entire framework. But the implications are enormous. A rental property that generates cash flow after expenses? Asset. An index fund that pays dividends and grows in value? Asset. A business that runs without requiring your constant time? Asset. A car loan? Liability. It takes money out of your pocket every month and the car itself depreciates. A credit card balance at 22% interest? Massive liability. A primary home you live in, even though most people call it an asset, technically a liability in the cash flow sense because it takes money out every month through mortgage, taxes, insurance, and maintenance. Now, here's where it gets really important. Most people spend their working lives buying liabilities and calling them assets. They buy a new car and call it a necessary expense. They buy a bigger house and call it an investment. They buy clothes, electronics, furniture, things that depreciate immediately and generate no income, and think of these purchases as getting things they deserve. Wealthy people are obsessed with acquiring assets. They measure their financial progress not by how much they earn, but by how many income-producing assets they own. The car example, the most expensive mistake most people make. I want to spend a minute on cars because I think it's the clearest example of how the asset-liability distinction plays out in real life. The average new car payment in America right now is over $700 a month. Add insurance, another $150 to $250. Fuel, maintenance, parking. We're talking about $1,000 to $1,200 a month going into a depreciating asset that loses 20% of its value in the first year and roughly 50% within 5 years. That $700 car payment invested instead at 10% for 30 years would be worth approximately $1.6 million. I'm not saying don't own a car. Transportation is often a necessity, but wealthy people think very differently about vehicle purchases. They drive reliable used cars. They avoid long-term loans on depreciating assets. They think about the opportunity cost of every major purchase. What else could this money be doing? The question wealthy people ask before any major purchase is not, can I afford the monthly payment? Because almost anyone can afford almost any monthly payment if they stretch it long enough. The question is this an asset or a liability? And if it's a liability, is it worth the cost of the assets I'm not buying? That question, asked consistently, produces completely different financial outcomes over a lifetime. Your primary residence, the complicated truth. I want to touch on something that's going to be slightly controversial because it contradicts what most people believe.
Most people think of their home as their most important asset. And in some ways it is. It provides stability, builds equity, and often appreciates over time. But in the strict cash flow definition we're using, where an asset is something that puts money in your pocket, your primary home is not an asset, it's a liability. Every month it takes money out: mortgage, property taxes, insurance, and maintenance. Now, this doesn't mean you shouldn't own a home. There are real non-financial benefits to homeownership. But it does mean you shouldn't stop there and assume you're building wealth. Wealthy people understand this distinction. They might own a beautiful primary home, but alongside it, they're also acquiring actual income-producing assets: rental properties, stocks, businesses. The goal is to build a portfolio of things that put money in your pocket. Your home is where you live. It should not be your entire wealth strategy.
Rule number 3, they make money work through leverage and other people's time. What school taught: trade your time for money. Work hard, earn your salary. What the rich know: use leverage, financial, human, and knowledge, to multiply output beyond your personal hours. There are 24 hours in a day. You can work maybe 10 to 12 of them sustainably, which means there is a hard ceiling on how much money you can earn by trading your time directly for dollars. Every employee, no matter how well paid, eventually hits that ceiling. Wealthy people understand something fundamentally different. The path to real wealth is not about maximizing your hourly rate. It's about removing the connection between your hours and your income entirely. This is the concept of leverage, and there are 3 types worth understanding. Type 1, financial leverage. Financial leverage means using other people's money to amplify your returns. The most common example is real estate. When you buy a $300,000 rental property with $60,000 down, a 20% down payment, and the property appreciates 5% in a year, the property is worth $315,000. You made $15,000 on a $60,000 investment. That's a 25% return on your actual money, not 5%. The bank's money is doing work for you. That's financial leverage. Business owners use it too. A business loan that funds equipment or inventory that generates revenue greater than the cost of the loan is leverage. You're using borrowed money to earn more than the cost of the loan. The key distinction: good leverage creates income that exceeds the cost of borrowing. Bad leverage, credit cards, car loans, personal loans for consumption, costs more than it produces. The rich use the first. The financially struggling are trapped in the second. Type 2, human leverage. No wealthy person who has built a significant business did it entirely alone. At some point, they stopped being the person doing the work and became the person organizing, directing, and benefiting from the work of others. This is human leverage. Employing, contracting, or partnering with people whose efforts benefit you financially. A business owner with 10 employees is effectively working 10 times the hours, even while they sleep. Each employee's productivity flows through the business and contributes to the owner's financial outcome. This doesn't require a large business. A freelancer who hires one virtual assistant to handle admin has created human leverage. A content creator who outsources editing, thumbnail design, and research has created human leverage. The mindset shift is from "how can I do more?" to "how can I build systems where others do more and I benefit from their output?" Most people are never taught to think this way. School teaches you to be a good individual contributor. Wealth building requires learning to think like an owner. Type 3, knowledge leverage. The third type is the most accessible and the most underutilized. Knowledge leverage means creating something once: a system, a process, a piece of content, a product that continues to produce value repeatedly without additional effort from you. A YouTuber who makes a video once and earns ad revenue from it for 5 years is using knowledge leverage. An author who writes a book once and earns royalties for decades. A software developer who builds an app once and earns subscription revenue indefinitely. The internet has made knowledge leverage available to virtually everyone. A course you record once can sell 1,000 times. An article you write once can drive traffic for years. A tool you build once can serve millions of users.
This is why digital products, content creation, and software businesses produce such extraordinary wealth relative to the hours invested. The ratio of input to output is fundamentally different from trading time for salary. Rule number 4, they think in tax strategy, not just gross income. What school taught, earn more money, pay your taxes, the government takes what it takes. What the rich know, the tax code is a roadmap. Those who read it keep far more of what they earn. Here is a fact that most people don't know and that changes everything once you understand it. In the United States and in most developed economies, there are effectively 2 tax systems. System 1 is for people who earn wages, salaries, hourly pay, W-2 income. This income is taxed at ordinary income rates, currently ranging from 10% to 37% federally, plus state taxes. This is the system most people live in their entire lives. System 2 is for people who earn investment income, capital gains, dividends, rental income, business income. Long-term capital gains on assets held more than 1 year are taxed at 0%, 15%, or 20%. Business owners can deduct expenses, depreciate assets, and structure income in ways W-2 employees simply cannot. The richest people in the world, Warren Buffett, Elon Musk, Jeff Bezos, often pay effective tax rates lower than their secretaries, not because they're cheating, because they earn income through System 2 instead of System 1. This is not a bug in the tax code, it's how it was designed, and it rewards people who understand it. The 3 most powerful tax tools available to regular people. Now, I want to be clear, tax optimization for wealthy business owners gets complex fast. You'd need a CPA who specializes in this. But there are 3 powerful tax tools available to virtually everyone that most people aren't fully using. Tool 1, the Roth IRA, tax-free growth. We've talked about this in previous videos, but it belongs here too because it's fundamentally a tax strategy. Money invested in a Roth IRA grows completely tax-free. When you withdraw in retirement, you pay $0 on any of the growth, no matter how large. You're converting ordinary income today into permanently tax-free wealth. Over a 30-year compounding period, the tax savings in a Roth IRA can easily exceed the total amount you originally invested. It is the most powerful tax shelter available to ordinary Americans. Tool 2, the 401k, pre-tax income reduction. Traditional 401k contributions reduce your taxable income in the year you make them. If you contribute $10,000 to a 401k and you're in the 22% tax bracket, you've just saved $2,200 in taxes immediately. That $2,200 you would have paid in taxes is now invested and compounding instead. Over 30 years at 10%, that single $2,200 becomes over $38,000. Most people think of their 401k as just a retirement account. It's also one of the most effective tax reduction tools available. Max it if you can, $23,000 per year in 2024. Tool 3, business deductions if you have any self-employment income, a side business, freelance work, a single-member LLC. When you have business income, you can deduct legitimate business expenses before paying taxes. Home office, equipment, software, professional development, travel for business purposes. These deductions reduce your taxable income dollar for dollar. A simple example, if you earn $5,000 in freelance income and have $1,500 in legitimate business expenses, you only pay taxes on $3,500. The government just gave you a 30% discount on your business costs. This is why wealthy people often structure their income through businesses rather than taking everything as personal salary. The deduction opportunities are far greater. The legal structures allow for more optimization. You don't need to be a millionaire to start using this. Even a simple side income, $500 a month in freelance work, opens up business deductions that W-2 employees cannot access. The key mindset: gross income is vanity, net is sanity. Here's the reframe that wealthy people carry, and most people don't. It doesn't matter how much you make. It matters how much you keep after taxes and expenses, and how much of what you keep gets invested in assets. Someone earning $80,000 who understands tax optimization might keep $68,000 after taxes and invest $16,000 of it instead. Someone earning $100,000 who doesn't think in tax optimization might pay $28,000 in taxes, spend aggressively on lifestyle, and invest $5,000. The lower earner builds more wealth because they think in after-tax, after-expense terms. They think about what they keep and deploy, not just what the top of their pay stub says.
Rule number 5, they play long games and ignore short-term noise. School taught, react to what's happening now, stay informed, follow the news. What the rich know, most financial news is noise. Wealth is built by ignoring it. This might be the most counterintuitive rule on this list because it sounds like advice to be uninformed. It's not. It's advice to understand what information actually matters for building wealth and what's just noise designed to keep you engaged with media, trading platforms, and financial products that benefit from your attention and activity. Let me explain what I mean. Every single day, financial news produces a flood of content. Markets are up, markets are down, the Fed just made a decision, a major company missed earnings, a geopolitical event is creating uncertainty, analysts are predicting a crash, different analysts are predicting a boom, and most people who consume this content do one of two things. They panic and sell, or they get excited and chase something. Both behaviors destroy long-term wealth. Studies consistently show that the more frequently individual investors check their portfolios and trade, the worse their returns. The investors who check least often, sometimes once a year or even less, consistently outperform those who are actively engaged with their portfolios. This sounds backwards, but it makes perfect sense once you understand why. Why wealthy people think in decades, not days. The wealthy people who have built generational wealth through investing share one trait almost universally. They think in extremely long time horizons. Warren Buffett's favorite holding period is forever. He's been buying Coca-Cola stock since 1988. He's bought more through multiple recessions, crises, and crises. He doesn't sell because the market is down. He doesn't sell because a quarterly earnings report disappointed. He buys businesses he believes in and holds them through everything. This is not passive or uninformed investing, it's a deliberate rejection of short-term noise in favor of long-term fundamentals. The average investor holds a stock for about 10 months. The average Vanguard index fund investor holds for about 10 years. The difference in returns between these two groups is dramatic, and it's not because one is smarter, it's because one is more patient. Patience in investing is a skill, and it's one that the financial industry actively works against because they make money when you trade, not when you hold. The news is not your financial advisor. Here's something I want you to really sit with. Financial news media is not in the business of making you wealthy. It is in the business of keeping your attention. Attention is sold to advertisers. Therefore, the content is designed to provoke emotion, fear, excitement, urgency, not to give you useful investment guidance. Every crash is coming headline, every this stock will 10x prediction, every recession is imminent warning, these are attention-capturing devices, not investment advice. The dirty secret of financial media, if you do nothing, if you simply hold a diversified index fund through all of it, you will almost certainly outperform most of the people who are actively responding to everything the financial news tells them to do. Doing nothing is hard. It feels irresponsible. It feels like you're not engaged. But for a long-term index fund investor, doing nothing during a crash is often exactly the right move. Wealthy people develop an almost eerie calm about market volatility, not because they don't understand the risk, they understand it better than most, but because they've accepted that short-term volatility is the price of long-term returns, and they've decided that price is worth it. The long game in practice. Let me make it concrete. It means setting up automatic investments and then not adjusting them based on news cycles. It means checking your portfolio quarterly or annually, not daily or weekly. It means having a written investment plan, your allocation, your target, your timeline, and following it regardless of what markets are doing. It means understanding that bear markets, defined as drops of 20% or more, happen on average every 3 to 4 years. They're not exceptional events, they're scheduled interruptions on the way to long-term growth.
And it means measuring your financial progress in years and decades, not months. Your net worth at 55 is what matters, not your portfolio value this Tuesday. Wealthy people are not smarter than you. They are not luckier than you, or at least not all of them. What they consistently are is longer-term thinkers, and that single difference in time horizon produces an enormous difference in financial outcomes. The rule that makes all the others work. They started. I want to leave you with one thing that ties everything together. Every rule I've talked about today, paying yourself first, acquiring assets, using leverage, optimizing taxes, thinking long-term, none of them work until you start. And the single biggest difference between people who build wealth and people who don't isn't intelligence, it isn't income, it isn't access to special information, it's that they started. Wealthy people started paying themselves first when they couldn't afford it. They started acquiring assets when their first asset was a single share of an index fund. They learned about taxes when their income was modest. They thought long-term when short-term felt urgent. Every expert in every field started as a beginner. Every million-dollar portfolio started as a first deposit. Every successful business started as an idea someone actually acted on. The rules I've given you today are not complicated. They are not secrets. They are available to anyone. What makes them powerful is not knowing them, it's applying them consistently for years. That's it. That's the whole game. 5 rules, 1 decision. Let's recap the 5 rules the rich follow that nobody taught you in school. Rule 1, pay yourself first. Invest before lifestyle. Automate it so willpower is never required. Rule 2, know the difference between assets and liabilities. Obsessively acquire things that put money in your pocket. Be careful what you call an investment. Rule 3, use leverage, financial, human, and knowledge leverage to multiply your output beyond your personal hours. Rule 4, think in tax strategy. Use Roth IRAs, 401ks, and business structures to keep more of what you earn. Gross income is vanity. Net is what builds wealth. Rule 5, play the long game. Ignore short-term noise. Think in decades. Let compounding do the heavy lifting that active trading never can. None of these rules are taught in school, but all of them are learnable. All of them are actionable, and any one of them applied consistently will move you further ahead financially than years of working harder without them. Pick the one that resonates most and implement it this week, not next month, this week. If you want to go deeper on any of these, I have videos on index funds, the Roth IRA, tax strategy, and the asset versus liability framework, all linked in the description. Subscribe if you found this useful. New video every week. Same mission, giving you the financial education that school never did. See you next time.